Is the S&P 500 index all you need in your portfolio? For most investors, the best strategy is to own an S&P 500 index fund. At least, that's what Warren Buffett said. But does it mean investors should focus only on the S&P 500? Or does it conflict with the idea of diversification for better stability and return potential? Hi, my name is Caroline Maughan, and I'm a portfolio manager at Claret Asset Management. Let's dive into the world's most well-known stock indexes and explore whether the S&P 500 is truly all you need. The S&P 500 is an index that tracks the 500 largest publicly traded U.S. companies weighted by market capitalization. In this type of index, stocks are weighted according to their total market value, also known as market capitalization. It's calculated by multiplying the share price by the number of shares outstanding. Larger companies have more influence on the index's performance than smaller ones. The index is considered one of the best gauges of large U.S. stocks and even the broader U.S. equities market because of its depth and diversity. While you can't directly invest in the S&P 500 index itself, you can invest through mutual funds or ETFs that track its composition and performance, effectively exposing you to the index. Advantages of the S&P 500. S&P 500 index funds provide broad exposure to a diverse basket of companies within the index, without investors needing to purchase individual stocks or pay high fees for actively managed funds. The S&P 500's widespread appeal is also in its strong historical performance. From its inception in 1957 to 2024, it has delivered an impressive annualized total return, including dividends, of 10.67% in US dollars. Many supporters of the index argue that professional fund managers who charge significantly higher fees often fail to outperform the index over time. Should you invest exclusively in the S&P 500? There are some important limitations to this strategy to consider. While the S&P 500 offers industry diversification, it's still entirely US-based, exposing you to US economic downturns and fluctuations in the US dollar. It's also all stocks, so it does not offer asset class diversification. As of the end of 2024, the top 10 companies made up 38% of the index, compared to the 23% that the top 10 companies represented at the end of the 2000 tech bubble. Since the S&P 500 is a market cap weighted index, as a stock becomes overvalued, it holds greater weight in the index and the concentration risk can magnify. Investing only in the index means you're overlooking one of the fundamental principles of diversification. You are diversified, but only within one country and one asset class, U.S. equities. The modern portfolio theory, developed by Nobel laureate Harry Markowitz, shows that balancing different asset classes and geographies can minimize risk and increase long-term stability. So is the S&P 500 all you need? It's a solid start, but for better risk management and growth, diversify beyond it across different sectors and asset classes. For more investment tips, visit our website at claret.ca or get in touch with us directly by clicking on the links in the description. And don't forget to click the subscribe button below.